Hey everyone, this is Kirk here again at optionalpha.com, and in this video we're going to go through our 7-step option trade entry checklist. Now as we complete track number 2 here, this video is meant to bring together everything that we've talked about and be your easy to follow checklist to ensure that you're placing option trades correctly. Remember, we do have a downloadable PDF of this if you want to download this checklist and read through it in a different format that is available for free here on Option Alpha. Now, in our opinion, this 7-step order entry recipe or checklist or whatever you want to call it is put together in a way that is logical in sequence, meaning 1 to 7, so that it gets you out of analyzing trades that don't fit the requirements. So we put portfolio fit first because if it doesn't fit this requirement of being a good fit for your portfolio, you're out of analyzing the trade. If it passes portfolio fit, then you move on to great liquidity. If it fails that, then you're out of analyzing the trade. So the whole goal here is to give you an opportunity to analyze trades quickly and move on from trades that don't fit or don't meet your criteria for entering a trade. So what we're going to do in this video is go through each of these with a couple little examples to help kind of, again, bring everything together that we've talked about here in track number 2. Now, the first thing, like we said, is portfolio fit. And this is really asking yourself basically 2 questions: balance and then beta weighting. So like we talked about before, you talk about balance, meaning the number of bullish trades or the number of bearish trades you have. How many neutral trades do you have? Like, what does your overall balance look like? Are you overbalanced, meaning you have too many bullish trades, you don't have enough bearish or neutral trades? What do you need in your portfolio to be as neutral as possible? What we do at Option Alpha is we group our trades by different strategy types and also by different directions. So you'll see that we also we have our iron condors here that we're trading right now. We have some calendar spreads that we're trading. We have one call credit spread that we're trading. So you can group it however you want. That's just a quick little tip on how you can kind of see balance. Maybe you group it by bullish or bearish or neutral, whatever kind of works for you. But we do like to have, as we've talked about previously, a lot of different positions that work in different ways, and also positions that work well when implied volatility is high or low, or all these kinds of different strategies that we can work at the same time. Obviously, the next important thing here is beta weighting. We went through an entire video training on beta weighting, but it's really important that you continuously try to trade as many uncorrelated assets and stocks as possible so that your overall portfolio is beta neutral or delta neutral to the market. This is a really cool little correlated asset table from Bespoke, basically talking about the correlations between different sectors and industries. So you can see here there's a high correlation between industrials and consumer discretionary. Okay, so high correlation there versus something that has very little correlation might be oil sector and the financials. Okay, so very low correlation. And again, it doesn't matter, and this is such an important point, it doesn't matter what you end up trading. So you could trade all financials or all healthcare or all industrials or whatever you want to do. Just realize that the more you trade a broad breadth of securities, ETFs, and ticker symbols, the better off your portfolio is, because you're going to have a lot of positions that are not correlated with each other. And again, it all comes back down to just understanding that beta weighting aspect of it. Is what does your overall portfolio look like? So whatever you end up trading, just make sure you beta weight your portfolio to some index on an ongoing basis so you know what you're looking for. Number 2 in our 7-step checklist is great liquidity. Now, hopefully this goes without saying, but great liquidity means minimal slippage. So lots of volume on the actual stock. That's one thing that we can always look for. And then number 2 is lots of tight bid-ask spreads. So even very tight bid-ask spreads far out of the money. So you can see at the time we did this screenshot with SPY, even some of the strike prices that were far out of the money had $2 wide spread or 2 penny wide spreads, 1 penny wide spread. So 1 penny narrow spreads. So very tight bid-ask spreads in SPY, and it should be because this is a major market ETF. This is in comparison to something like AVB, which we just randomly picked, but kind of proves the point here, where the slippage is incredibly high because it doesn't have a lot of volume and liquidity. Notice that there's not a lot of volume. There's practically no volume and open interest in either the calls or the puts on both sides. And as a result, you're looking at basically $50 wide spreads in some cases, which are for at-the-money options, which is incredibly wide. It means you're just going to lose a lot of money based on slippage alone. Now again, here at Option Alpha, we've already done the heavy lifting for you if you go ahead and purchase a lifetime copy of our watch list. And basically, we've already pre-screened and continue to pre-screen on a reoccurring basis the stocks and options that have the highest liquidity. And that's all we look at. So that's why we don't have the functionality, nor do we want to put in the functionality to search for different stocks that are off of our watch list. There's generally around 100 stocks on our watch list at any given time, but things like Twitter and GoPro and SolarCity and LinkedIn, I mean, all of these stocks have incredibly high liquidity and their options are also very liquid as well. So if you want to avoid the slippage, and you can go out and look for it yourself and do the calculations and look at it, but we've already done, again, the heavy lifting for you. Number 3 is implied volatility rank, or IV rank. Now again, this is a really important component that you know heading into a trade because it determines the type of strategy that you're going to select. Again, what's important here about implied volatility rank is not the actual implied volatility number that you're looking at for whatever stock. It's asking yourself, where is that number in its historical range? So if we're looking at Apple stock, for example, and we see that implied volatility in Apple is actually reading at 25%, we need to ask ourselves, is 25% relatively low for Apple? Maybe Apple usually trades with implied volatility around 75%, or whatever the case is. So again, what we've already done is pre-built our watch list here at Option Alpha. And again, what you can do is you can come in here and sort by highest implied volatility to lowest implied volatility, everything that we're looking at. So it makes it incredibly easy for you to see IV rank of anything that's on our watch list with either high implied volatility or again, low implied volatility. It's all pulling in here for you at one time. Number 4 is your options strategy. So now that we know where implied volatility rank is, and you can see why this, again, the 7-step checklist is in a sequential order. Now we know where implied volatility rank is. Now we can determine the option strategy. In my opinion, this becomes the difference maker between those who are successful trading and those who aren't, is understanding which option strategies work best in which implied volatility markets. Generally, we want to be selling options when implied volatility is over the 50th rank. We want to be buying options if we do, generally when option volatility rank is below 50, even towards the lower ends, as a real kind of means to really take advantage of low implied volatility. So that's the difference maker. Then within each of those implied volatility ranks, you could get more or less aggressive with your option selling. Again, as we've done here at Option Alpha, based on all the feedback that we get from our members, we have pre-built in this ability to look for the best option strategies already based on implied volatility rank of whatever you're looking at the moment. So for example, if you're looking at AXP for a trade and implied volatility rank is at 50, you know that the best option strategies are credit spreads, butterflies, or iron condors. Again, you can choose between those based on what you like to trade or what you understand to trade. It doesn't really matter at that point. Then if you kind of scroll down and you see something else with higher implied volatility, say you're looking at MON, which has an IV rank of 70, you can see that the strategies that we can choose now depend on that implied volatility rank of IV 70. So the best strategies include straddles, strangles, or iron butterflies. As a final comment, obviously, we always include an IRA appropriate strategy for every level. So you'll never be left out if you have a small account and you can't trade undefined risk strategies like straddles or strangles, and you have to trade something with defined risk like an iron condor or an iron butterfly or a credit spread, something like that. The next thing that you do once you've determined which strategy you're going to select is determine which strike prices and which month you want to trade for your contracts. Now this gets back down to this idea of pinning or anchoring your probability of success. What we do here at Option Alpha, as we mentioned a bunch of times, is we basically build all of our trades to have about a 70% chance of success. So if we look at this trade, which is a trade that we have on at the time that we recorded this screenshot, you can see that we were trading SPY by selling a credit spread above the market. When SPY was trading at 204, we sold the 208, 209 credit spread. Again, at the time, that had about a 30% chance of being in the money, or the probability of being in the money was about 30%. That means that the probability of winning or this trade being out of the money is about 70%. So that's where we target all of our trades. If, for example, you wanted to be a little bit more conservative, and let's say you wanted to trade something around an 80% chance of success, you would find the probability of being in the money at 20%, or the delta around 20, and that gives you approximately an 80% chance of being right. Or let's say you want to trade something with a 90% chance of being right. So again, you find the 10 delta or the 10% probability of being in the money, and that gives you about a 90% chance of being right. So now you start determining which strike prices you want to be trading based on this idea of pinning your probability of success and continuously targeting the same likelihood. Again, as just another refresher, generally speaking, as far out as you go, we usually like to do things with high implied volatility, so option selling strategies, a little bit closer in, so 30 to 45 days. That's kind of like the sweet spot and range. Doesn't mean that we'll always do things exactly between 30 and 45 days, but that's the sweet spot. When there's low implied volatility, we want to extend our trading duration and we want to trade things anywhere between 60 and 90 days out. Okay, so again, that's not hard and fast rules. It's just a general guidepost. You generally want to take advantage of that longer time period so hopefully the stock swings into your range. Now, once you've determined the implied volatility rank, option strategy, the strike prices a month, now we have to talk about position size. Now, this is obviously something that we've talked a lot about here and is, again, critically important. We use a sliding scale approach here at Option Alpha. So for us to be able to make a lot of trades, which increases our chance of success, we need to make sure that our positions are so small that one or two trades that go very bad won't blow up our account. Because remember, black swan events are going to happen. There's going to be trades that go completely against you. And the only way to protect yourself is keep your trade size small. So again, we use a sliding scale approach between 1 and 5%. The only time that we'll really edge toward 5%, and we rarely get towards that 5% level, is when implied volatility is really, really high. Okay, so when we have an insane amount of edge, theoretically, with implied volatility so high, that's when we'll start to scale up. But most of the trading that I do personally is on the small side with implied volatility generally even high. We still want to do our positions really, really small so that the likelihood or the odds that our account blows up from one or two positions going bad is really small. So again, we can use this sliding scale approach and our trade size and allocation guide to basically determine how big our position sizes should be. So if you're going to focus on each position being 2% of your account balance and you've got a $15,000 portfolio, then you need to make sure that you're taking on no more than $300 of risk per trade that you're entering. That doesn't mean that you can't do 4 or 5 contracts. It just means that all of the contracts for whatever symbol you're trading is no more than $300 of risk. Okay, again, if you're targeting a 2% allocation per trade. The final thing that we have to talk about here, number 7, is future moves. Now, this is important because I feel like you should always be aware, but not attached to something happening in the future. So have a general awareness of what's going on. Don't live in the hole, right? But at the same time, you don't need to follow the news each and every day. So everything you need to know is already priced in. In a fair, efficient, liquid market, most of the news is already priced in. Again, that doesn't mean that you need to be ignorant to the fact that jobless claims or unemployment is, coming out and that might move the market, or the Fed funds or earnings are on the horizon, right? So just be aware of those types of things. Again, another thing like we talked about, know when the earnings are, know when dividends are, know some of these, kind of events in the future. One of the cool things that we've already built into Option Alpha is the ability to track and see when earnings are. So for example, here with some of these stocks, you can see that we do have this earnings kind of tag. I just want to scroll down so you can see different ones. But this earnings tag, if any stock has earnings coming up in the next 45 days, this purple tag will be added to the watch list. You can see PBR does not have earnings coming up. Any ETFs, they obviously don't. But it just makes you aware of any possible earnings events that you can just, again, kind of know that it's on the horizon. Take a look at it, maybe make an adjustment to your strategy or not. It doesn't matter. But being aware, I think, is the most important thing. So congratulations on completing track 2. That is the 7-step entry checklist. Thank you so much for taking the time to go through this. I hope that track 2 was really helpful in getting you over the hump from becoming a beginner to becoming now a little bit more professional in how you approach your options trading. As we get into track number 3, or as you move on to track number 3, we're now going to take everything from beyond order entry. So track number 2 here was basically designed to get you all the way up to placing and entering trades. Now track number 3 is going to take everything beyond that, which is managing trades, exiting trades, adjusting portfolios and trades, kind of managing yourself as a professional trader. So again, hopefully this has been incredibly helpful for you. I'd love to hear your comments and feedback. If you love it, please let us know. Please share these videos online with your friends, family, coworkers. Help spread the word about what we're trying to do here at Option Alpha. And until next time, happy trading.